Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
I'm doing great. It's a pleasure to be here, Ross.
Yeah, good to talk to you as well. Obviously, kind of a lot going on in markets, a little bit of volatility here. So I want to get your view of it from the fixed income world. Let's start with how you addressed it yesterday. We're recording on Wednesday, so a bit of volatility to start the week, but via high yield spreads, right? So the spread of how much you can get on a high yield bond versus a treasury typically widens in time of weakness. What are you seeing from high yield spreads, default rates, and what is it telling you about the economic outlook going forward?
Well, I think the first and most important thing to remember right now is that both defaults and spreads are exceptionally low. And what I mean with that, on the default side, we're looking at high yield defaults around 2.5% or so. The long run average is something more like close to 4%. So we're well below the long run average. But what has been concerning over the last few years is that we've gone from almost 0% defaults up to 2.5%. And it looks like we're making another move higher again. So defaults do appear to be rising, albeit off of very, very low levels. On the spread front, it's kind of a similar story. High yield spreads typically might average, in a non-recessionary period, somewhere around 450 or so basis points. And we're at 290 basis points or so today. So we're well below the long run average. And typically, you don't see high yield spreads below 300 basis points unless there is an unusual amount of liquidity and leverage in the buyer base. And so we're at 290. We were down to 250 just 2 weeks ago, which was a multi-decade low. So the trend for both defaults and spreads appears to be higher, but the base levels that we're coming off of are very, very low. So if there's a signal here, it would be consistent with the headlines that people are seeing in the media. The economy does appear to be slowing, and you're starting to see some credit risk build into the credit markets being priced in, albeit off of very low levels just 2 weeks ago.
Yeah, so seemingly at this point, consistent with what is being called a growth scare, but maybe not outright recession fears, at least in the near term. I want to get your thoughts on the Federal Reserve here because I think they find themselves in a pretty tough spot. If the growth scare scenario continues, they obviously have tools. They can lower interest rates. They're above their neutral rate at this point, so they could lower interest rates. But they're also very concerned about the potential for a second wave of inflation, and particularly have been IDing, tariffs as something they're watching closely. What do you make of the Fed's position, and do you think it's more likely that we'll see more cuts in the back half of 2025, or that they're forced to kind of hold steady?
This is a tough question because I think the Fed over the last few decades, but in particular in last decade when there were tariffs that were implemented, the Fed has shown an awful lot of academic stubbornness, we'll say. And by that, I mean a pure insistence that tariffs are inflationary and it's just, not questionable whether they aren't. And I think we saw in 2018, they proved that they were not inflationary. The Fed held the policy rate too high for too long. And once again, we saw the economy begin to slow without inflation really making any material move towards their target. Today is a little different, obviously, because inflation is still above their target. And there are some nuances that would make the current tariff platform seem a little bit more inflationary than what we saw in 2018. And I think that's an understatement. So I think there's some justification this time around for the argument that tariffs could prove inflationary this time, whereas they did not prove inflationary in 2018. With that said, I think the Fed is really just kind of looking at the data and just like the rest of us is making it up as they go along because the data is evolving rapidly. The data is contradictory. So 1 week it says one thing, another week it says another thing. A month and a half ago, we had jobs data that said the economy was booming. We just got an ADP number about 30 minutes ago, and it shows that there were very little jobs added. So Friday's jobs report is going to go a long way towards informing the Fed's decision. And that decision is very likely to be another pause with a next rate cut out to probably June now, maybe May, but a pause at the next meeting. And I think that pause is warranted. So I do think that despite the fact that there's a lot of rigidity at the Fed in their decision-making process, the fact that they have been on pause for a few months is the right decision until the data proves to them that they should ease again. And now, with that said, what's our forecast? Our forecast is that the economy is going to continue to slow in the first half of 2025, more or less forcing the Fed's hand to ease, not just once more this year, but twice more this year. And inflation is also, in the near term, going to move a little bit lower and then move sideways. But the concern about a second wave of inflation is well founded. We do believe that we will see a second wave of inflation later this year or early next year. And we argue that it's not going to be tariff driven. It's going to be service sector inflation driven because there is still an imbalance in the service sector and there's still a skill mismatch across much of the US economy. And that's going to be the driver. But for now, our base case is rate cut in June, and at least one more between June and the end of the year.
Tom, this has been really insightful. Always appreciate the thoughts. Thanks so much for the time and look forward to talking again soon.
My pleasure. Thank you, Ross.